Well, Blair, out of respect for people's time, shall we go ahead and get started?
Yeah, sure. And people can pop in as they join. Welcome, everybody. Thank you for joining this town hall meeting this afternoon. Today, we want to accomplish a few items. One, I'm chair of the Foundation Investment Committee, so we can just provide a little update on what the investment committee has been working on over this last year. Two, Joy will provide update information, more of an educational session on the Atlanta Jewish Foundation. And three, the bulk of today's presentation will be done by Asher, representative consultant with NEPC. NEPC is our outside investment manager. So that's where we are. All right, moving on to the next slide, Joy. I think there should be a slide. Yeah, this is the investment committee. As I mentioned, I'm chair. Beth serves as the foundation chair of the Atlanta Jewish Foundation. And then up here on the screen, show the committee members. And we've been hard at work, various meetings, various sub-task force over this past year. So I just want to thank everybody and recognize everybody on this committee. As everybody on this call should be aware, we consolidated the number of available portfolios. Previously, we had underutilized and some at times just non-used investment models, investment portfolios. So over the last 6 months, 3 to 6 months, we've gone through that consolidation process. There are now 4 investment models to choose from. You, as either as a donor advised fund or representative from the agency, would have selected which model you're in. So that's been completed. We've also worked on putting together the investment policy statement for outside managers to make sure that their investment allocation is within the guidelines, within the benchmarks of the Atlanta Jewish Foundation. 3, we created a task force to really dive deeper into the ESG portfolio. With that, we work closely with NEPC, create an investment policy statement specific for the ESG portfolio, and have put processes in place where we're using NEPC's rating system. They rate the firm of the underlying asset manager as well as the strategy to make sure that they are in compliant and scoring highly on the ASG. Asher can talk more about that this afternoon. So we've developed that, and that investment policy statement was actually approved at today's investment committee meeting. 4th, we've started the process of exploring potentially using private markets to supplement within the portfolio, whether it's on the private equity side or on the private debt, private credit side. We're starting to have that conversation, possibly incorporating that into the investment portfolios. There actually, strangely enough, was an article in today's Wall Street Journal about this, just saying, the returns are in the public markets going forward are somewhat low expectations, and one way to increase returns is through that private markets. But the investment committee is trying to balance off the risk, the liquidity, and whether it makes sense for the foundation or not. So that's what the investment committee has been busy working on this last 12 months. On that note, Joy can provide some education on the foundation.
Awesome. Thank you, Blair. So I'm Jory Mendel. I am the Chief Foundation Officer of the Foundation. For those of you I don't have the pleasure of knowing, I am grateful for Blair for his leadership of the Investment Committee and all of the incredible people who serve on that and make sure that we are upholding our fiduciary responsibility to all of our fund holders. So thank you all for being here today. I just wanted to share a little bit about our growth trajectory and what we've been able to accomplish this year. So we currently have 434 million assets under management. We've had about nearly 119 million in contributions this year. So it's been a pretty big year. Generally, we have around 40 to 50 million in contributions. And that enables us to do what we do and what is most important, but to put that impact back out into the community. And many of you are our fund holders doing that daily. So we've put nearly over $36 million back out into the community this year. Of those dollars, generally the breakdown is about 80% go to Jewish nonprofits and 20% go to other. And then of that even further, about 70% stay here in the greater Atlanta area. And the rest of the 30% is split between national and overseas. So you can see where that's all going. I do encourage you, if you are an agency and you're not exactly sure of, how many funds have come to your organization from the Atlanta Jewish Foundation, it's our pleasure to pull that kind of a report for you and to help you see how that's all working for your organization and to serve as a resource in that way as well. There's been over 1,000 grantee organizations that have received these dollars this year and over 4,000 grants. So it's been a busy time for the community and for all the philanthropists, and we're happy to be a part of that and be a conduit to helping people put more philanthropy out there. I do also want to take a moment, it's not on here, but to remind you all that one unique aspect of what we do here as well is we accept a liquid gift. So that can be real estate, appreciated stock, different kinds of assets. So that can be directly from our fund holders, or if you have a donor who's looking to make a gift like that to grow your endowment, that is something that we do specialize in. And I definitely encourage you to reach out to us when you have one of those opportunities. We're happy to work with you on that as well. So with that, I am going to stop sharing and I'm going to invite Asher Watson, who is our wonderful partner at NEPC, to share a little bit about the market performance and how our investment pools are performing today. So Asher, take it away.
Wonderful. Thank you, Jory. Great to see everybody. Just a quick introduction of myself, Asher Watson. I'm a senior member of the endowment and foundation team at NEPC. So focus all my time working with other nonprofit organizations similar to AJF. Our relationship with AJF is that of an OCIO, or outsourced chief investment officer structure, as Blair had mentioned. So what that means is that NEPC is investing the investment pool assets on behalf of AJF within the guidelines established as part of the investment policy statement. So we are tasked with utilizing and choosing investment managers, implementing those investment managers into the portfolio, and then as well as tactically shifting or rebalancing the portfolio based on opportunities that we see in the markets. And we've been doing this with AJF since the start of 2021. Our contract came to fruition, and then management of the assets itself really established about 1 year ago in April of 2021. So 1 year of track record. It's been a great relationship so far. And as Jory and Blair had shared, we've made a lot of progress as it relates to policy guidelines and establishment of guidelines like the ESG portfolio, and excited for our next conversation around private markets. So what I'll do today is, really threefold. I think the first is a quick update on market performance for the first quarter of 2022. Been a bit of a shift than what we've experienced for the past 10 years at this point. Talk about the investment pool consolidation, and lastly, just give an update on performance for the investment pools themselves. So that sounds good to everybody. I will share my screen here. There we go. Okay, perfect. So what you'll see on screen here, this is page 4, is a snapshot of asset class returns for the first quarter of 2022. And you heard me mention that we've been in a really strong environment for equity assets for really the past 10 years. Certainly the case over the past 2 years, 2020 and 2021. Generating very strong returns for equity markets. That has turned on its head a little bit as we shift into 2022 here. And what's interesting is that we're in an environment where both stocks are down, equity markets are down, but also fixed income assets are down. And that's a bit of an anomaly relative to history. Typically, when equity markets sell off a little bit, you would expect to see the fixed income assets appreciate in value. There's typically a negative correlation there when equity markets are down, but that wasn't the case during the first quarter of the year. And almost all of that can really be attributed to the interest rate environment that we've seen, and the fact that interest rates have increased and will continue to increase over the course of 2022 and likely into 2023. The S&P 500, that's large cap US equities, was down roughly 5% for the first quarter of 2022. International markets, that's MSCI EAFE, you see there, which is predominantly developed Europe and Japan, down a little bit more than 5%. And then emerging market equities, that's MSCI EM index, down a little bit more than that. So all equity asset classes during the first quarter of the year in negative territory. And then, as you heard me mention, as interest rates have started to go up, that has a negative impact on the performance of bonds. You see negative returns for the fixed income asset classes, and those are identified by the Bloombergs that you see there. Bloomberg aggregate, that's what we call core bonds. So that's going to be a portfolio of treasuries, investment grade credit, securitized bonds. That was down roughly 6% for the year. So really large cap US equities, core bonds, US bonds, both down about the same amount to start the year. Beyond that, what we did see is really strong performance in one asset class, and that's all the way on the right-hand side of the page there. That's the commodity market. So when we have rising inflation expectations and then supply chain constraints, which have been driven by the war in Ukraine, Russia being such a large supplier of energy, and beyond that, both Ukraine and Russia being large suppliers of grains. The inflation plus those supply chain constraints have really acted as a positive backdrop for commodity markets. So you see commodities were up roughly 25% for the quarter, and that was a trend that continued relative to the end of 2021. So commodities have performed very well over the prior 1 year period. Jumping ahead to page 5, the path for equity markets to start the year has been quite volatile. So what we have here is the cumulative total return for the S&P 500, large cap US equities, and then the MSCI ACWI, that's the all country world index, ex-US. So that's going to be comprised of international, developed equities, as well as emerging market equities. And you can see that both markets really moved in unison with one another over the course of the first quarter, a lot of up and downs. At one point during the quarter, equity markets down minus 12% with a slight rebound towards the end of the year. If we were to look at this chart again, taking April into consideration and taking market performance yesterday, we would see that equity markets for the year are down roughly 10%. Saw a little bit of a rebound today, but we do anticipate this volatile path likely to persist on a go-forward basis, not necessarily down, but likely a bumpy ride along the way. One additional sort of anomaly that we did see over the course of the first quarter was a rotation from a style perspective. So really over the past 2 years and prior to that, really the 10 years, being invested in companies that have a growth orientation. So technology companies, healthcare companies were really the place to be invested within equity markets. They far surpassed and outpaced those of more value-oriented companies. That's changed pretty significantly here in the first quarter of the year, as value-oriented companies have now far outpaced the performance of more growth-oriented companies. So page 6 of the materials here is the Russell 1000 value performance minus the Russell 1000 growth performance. You can see that dispersion was about 8% during the first quarter of the year, which is one of the top 10 largest dispersions on a quarterly basis in history. And one of the reasons for this is that growth-oriented companies are impacted more by higher interest rates. So growth-oriented companies utilize these interest rates to discount back. And so as interest rates go up, the amount that they're discounting also goes up, and that has an adverse impact on their valuations ultimately. So there has been a bit of a style rotation, and this is something that NEPC was recognizing and did make some changes as part of the portfolios. We did add some dedicated value exposure within large cap US equities during the first quarter of the year. So we've looked to move the equity implementation of the portfolios to what I'll call more of a core orientation. So not a high bias towards growth companies or value companies, but one that's now more core in nature. With the change in equity markets, certainly come the change in rate expectations. And what we have here on page 7 of the materials is the Fed funds futures rate, so really market rate expectations for potential rate hikes over the course of the year. And if you look at this data, the lighter blue line there as of 12/31/2021, what this would indicate is that the market thought the Fed would increase rates 2 or 3 times over the course of 2022. If we looked at this data at the middle of the quarter expectations were that rates would go up 5 times over the course of 2022. Now the market is pricing in up to 9 rate hikes over the course of 2022. So it's been a very quick transition in terms of market rate expectations, and that's largely driven by inflation and the Fed's desire and need to get inflation under control as we continue to see inflation rates increase. So, we've seen 1 rate hike in March, likely to see more rate hikes in 2022. I think one thing that we're certainly monitoring is the pace at which the Fed does increase interest rates. Typically, they increase interest rates 25 basis points at a time. That would be a 1 rate hike move. It's possible that the Fed may increase by 50 basis points in the future. So sort of the path to get to that level remains unseen, and important to note that this is not set in stone. This is what the market is anticipating, but there could be fewer, there could be slightly more rate hikes over the course of the year. But bottom line here is that interest rates are certainly rising. And with that, we have the inflation expectations as well. So on page 8 of the materials, this is what is called break-even inflation. So this is the difference between the yield on a nominal bond, so a typical treasury investment, and then an inflation-linked bond. What we've seen is that near-term inflation expectations have risen considerably over the course of the prior quarter. So 1-year inflation expectations based on the break-even as of 12/31/2021 was roughly 3.75%. As of 3/31/2022, that break-even inflation expectation is now 4.57%. So certainly expectations that inflation is going to stay high. NEPC's view here is that over the long term, inflation expectations likely to normalize a bit. So our 10-year inflation expectation is about 2.5, 2.7%. But we do recognize that inflation will be higher in the more near-term time horizon, elevated over the 1 to 3, 1 to 5 year time horizon. But over that longer-term time period, there are deflationary pressures at play, like an aging demographic and technology advancements, which will help mitigate some of the impacts of inflation over the long-term time horizon. And so, as I mentioned, one of the reasons that we have made a bit of a shift in the portfolio, adding that value exposure, is that we recognize interest rates are going up as the Fed tries to combat inflation. That should benefit value-oriented companies over growth-oriented companies. We also recognize that the equity risk premia in the near term, isn't what it was, let's say, 3-4 months ago. So we have taken some of the equity exposure off the table in both portfolios and added that exposure to a short-term credit fund that has an attractive yield at roughly 3.1%. So we have made some moves in the near term. I wouldn't say these are 1 to 2 week moves, but these are more intermediate time, let's say 1 to 6 months, 1 to 1 year kind of time horizons here. And the last thing I want to touch on, page 9, you heard me mention the really strong environment for commodity markets. Over the first quarter, commodities up north of 25%. A lot of that performance driven by the energy sector within commodities, up almost 45% for the quarter, in addition to grains and industrial metals. So not driven by one particular commodity itself, but really driven by a basket of commodities. Given the inflation sensitivity and the positive correlation that commodities often have to inflation, but also the supply chain constraints and the dislocation that's being caused in these commodity markets from the war in Ukraine. So why don't I pause there to see if there are any questions on markets at all.
Asher, this is Stephen Catronell. I don't know if this is coming up in your presentation later on, but at some point, will we see what our peer group looks like and how we compare to their returns?
Yeah, it's not in the presentation, but data that we can certainly provide to Jory, and it can be distributed to the group. We can certainly do that.
Great.
So if there are no other questions on markets, maybe I'll just spend a quick minute on our key market themes here on page 10 of the materials. Key market themes really being the economic drivers for market performance into the future. So themes that we anticipate will persist for a multi-year time horizon, but to the extent that there's any dislocation as one of these themes, we may anticipate to see volatility come through into the markets. What we had as a theme coming into or near the end of 2021 was a theme called virus trajectory. We have removed that theme here. That's not to say that we don't believe the virus is still impacting everybody, but its impact on markets themselves has been more subsided. So continual lockdowns or increase in cases wasn't impacting equity markets the way that it was sort of at the end of 2020, mid 2020 and into early 2021. So we've removed that theme and it's been replaced by economic crossroads that came on here as of 12/31/2021. And economic crossroads is really trying to signify that we are moving into potentially a new regime. For the past 10 years, we've been in an environment where asset pricing has been largely driven by sort of the Fed and the amount of stimulus and the accommodative policy that has been in place. We recognize that that is now evolving and changing, and the accommodative stance is being mitigated or going away as the Fed starts to increase rates and starts to reduce its balance sheet pretty significantly. Markets are now going to be more driven by sort of pure economic fundamentals. And so that's a shift relative to where we've been for the past number of years, and ties in nicely with the permanent intervention theme, which is exactly that. It's the theme that the Fed and central banks and the government has continued to provide stimulus and accommodative policy for markets, and that's really propped up a lot of valuations on the equity side of things. Those permanent interventions, as I mentioned, are going away at this point, and so that permanent intervention theme has moved from once being sort of prevalent in nature to one that's faded and likely moving to dormant and perhaps disappearing. So those two economic crossroads and permanent interventions tie in nicely with one another, and we've seen sort of the re-emphasized focused on pure economic data and fundamentals with that economic crossroads theme. Okay, so I will jump ahead and change gears a little bit here and just highlight the investment pool consolidation itself. So Blair had provided an overview of, pre 2022, the investment pool structures. There were 6 investment pools, and what's taken place over the first quarter of 2022 is a consolidation. So I think, as most of you know, ultimately what happened is that the moderate pool and aggressive pool consolidated into one and became what is now called the moderate growth pool. And then the conservative limited growth and conservative pool have been consolidated into what is now called the conservative growth pool. In addition to that, the money market portfolio and ESG portfolio remained unchanged, so the same asset allocation structure was in place. It was really the core investment portfolios that consolidated. And so that consolidation took place over the early parts of 2022. The portfolios now at the end of March are fully in place, and the portfolios have transitioned to their new asset allocation structures. The moderate growth being the more aggressive portfolio, I will call it, targeting a higher return, having a higher equity allocation of 70% relative to the conservative growth portfolio being more balanced between stocks and bonds, having 45% in fixed income, or excuse me, equity investments, 50% in fixed income investments, and 5% in multi-asset. So that's the big dispersion there is the overall equity exposure, one being at roughly 70% and one being at 45%. But now both those pools are fully implemented and fully in place. Here's just a snapshot of those target structures, page 13, showing the conservative growth portfolio at that 45% in equities, 50% in marketable debt, and 5% in multi-asset. Whereas the moderate growth portfolio is at that 70% equity number, 23% in marketable debt, 2% in liquid real assets, and 5% in multi-asset. As Blair had mentioned, we are having those initial conversations around private markets, not something that we anticipate happening in the near term here, as we sort of just evaluate the opportunity set for potentially the moderate growth portfolio. So in those initial phases right now of that conversation. Any questions there on the consolidation or the investment pool structures? I guess I should mention that the ESG pool, that target structure is 60% in equities, 40% in fixed income, so that remains unchanged. And then the money market pool is 100% in money market investments. Okay, great. So the last item that we would just touch on here is page 16 of the materials, and this is a snapshot of portfolio performance over various time horizons, really focusing in here on the 3-month period and the 1-year period for the investment pools. Over the first quarter of 2022, the moderate growth portfolio was down 5.3% relative to its benchmark, its simple benchmark down 5.5%. The simple benchmark being a balance of stocks and bonds, 70% MSCI ACWI or global equities, and 30% Barclays US aggregate or core bonds being the simple benchmark. So outperforming that by roughly 20 basis points during the first quarter of the year. The conservative growth portfolio down 5.6% relative to its benchmark down 5.6%. And, this really goes back to my initial comments about this being a unique environment where both equities are down. Typically, you might expect to see a conservative portfolio outperform, but given that interest rates have been rising, that's been negatively impacting the fixed income positions in the portfolio. You see returns that are roughly equivalent to one another over that 3-month time period. Over the 1-year period, we are in positive territory for the moderate growth portfolio, up 2.4%, and slightly negative for the conservative growth portfolio, down 0.7%. And then you can see below that the performance for the money market pool, relatively flat over the 1-year period. There are a few basis point gains in there. What we have seen more recently as we look into April is that the yield on these money market investments has started to increase. So money market historically for the past number of years having a 0% yield, we are now seeing yield sort of in the 20 basis point level. So starting to see some yield and return being generated from that portion of the portfolio. If it's of interest, Blair mentioned a little bit about the ESG portfolio. I'd be happy to spend a minute or two just talking about NEPC's rating process as it relates to investment managers and ESG integration. Jory, does that sound good? Okay, perfect. So, Blair and Jory had mentioned that an ESG policy is now in place, which sort of overrides the focus of this ESG portfolio. And what we ultimately decided on was to rely on NEPC's ESG ratings for investment managers. And so NEPC evaluates all of the investment managers that we put in client portfolios from an ESG integration perspective. So important to recognize ESG integration doesn't mean that the investment managers are only investing in good companies or what might deem to be good ESG companies. We're really looking at the way that these managers integrate environmental, social, and governance characteristics into their investment process. So the underlying companies that these managers are investing in or bonds that they're investing in, are they analyzing the ESG risks associated with those companies themselves? Do they have an impact to benefit return, or are there risks at play as it relates to ESG that they need to be thinking about? And so our ESG integration rating combines both a firm level assessment and a strategy level assessment. So one of the managers that we have in both the moderate growth and conservative growth portfolios is a manager called Axiom. So just using them as an example, NEPC will evaluate the ESG from a firm level perspective. So we'll evaluate Axiom as an entity to understand the policies and practices that they have in place as it relates to ESG, understand their proxy voting, and then beyond that, we'll then meet with the investment teams themselves to understand how they integrate ESG into their investment process. Those two ratings ultimately get combined into one rating. That one rating is what we give to the product itself. And those ratings range from 1 to 5, 1 being best in class from ESG integration, 5 being really no considerations around ESG integration at all. The ESG portfolio, once the policy is finalized and approved by the board, will ultimately be focused on managers that have an ESG rating of 1 or 2. So really best in class from an ESG integration perspective, something that we'll be monitoring on a quarterly basis and reporting to the investment committee on a quarterly basis, both to the overall ratings of the portfolio itself, but also the ratings of the individual managers that make up the portfolio. And then we do have detailed write-ups that we'll be providing on each individual product that has the assessment at both the firm level and strategy level as well. So this is sort of phase one of the ESG portfolios policy that will be in place, and something that we'll be looking to transition towards probably over the second quarter of 2022.
Thank you, Asher. So now is your opportunity to ask questions, and we invite you to do so. Feel free to raise your hand or just come off mute. We're a small enough group where we can do that. I think we did receive a few questions in advance, but I think from your presentation, we've answered those questions, but please, I'll open it up. Elliot, I see you're off mute. I don't know if that's because you have a question.
No.
Okay. All right. I don't know if it's the hour or Asher just, oh, there's Stephen Cadronell. There you go. Oh, but you need to come off mute, Stephen.
Thank you, Jory. Asher, it's all a lot of great information to digest. Again, for me, I kind of look forward to seeing how our performance benchmarks against other peers. Otherwise, it's just kind of hard to understand how good of a picker we are versus the rest of the world right now. But are there any shifts in strategy that you're suggesting, or are we too early in a volatile market to know what direction, if any, we might shift?
Yeah, it's a great question, Stephen. So we have made some slight adjustments to the portfolio. We have no recommendations to the investment committee as it relates to strategic targets for the portfolio, that 70% equities, 23% fixed income, but we have been mindful about some slight adjustments. So I mentioned that we added large cap value exposure to the equity portion of the portfolio. The funding source for that was traditional S&P 500. That exposure shifted into a more value oriented approach, whereas let's say we were 20% in S&P 500, we're now 13% in S&P 500, 7% in value orientation. So that's a pretty sizable shift as it relates to US equity exposure for the portfolio. All in all, that brings us to a slightly more core positioning for equities. Beyond that, we have slightly reduced the overall equity exposure of the portfolio by about 2 or 3%. So if targets at 70, portfolio exposure now in April for equities is sitting at 66, 67%, with a slight overweight now to fixed income, and that fixed income exposure coming in the form of short duration credit exposure with that roughly 3.1% yield that we're getting from that. So a better alternative to cash, which is yielding nothing. We're at least getting a little bit return out of that short-term credit exposure. Now, I would say beyond that, we are thinking about sort of commodity-oriented exposures, if you will, things like natural resource equities and infrastructure equities, which may make their way into the portfolio as part of moderate growth. We do have some real asset exposure already in the form of a diversified bucket that has some commodities and some natural resource equity and some TIPS exposure in play already. But that's something as a firm we're thinking about. And I think what becomes difficult there is, while it may seem like an attractive opportunity to invest in a commodity-oriented market right now or sector right now, it's when does this dry up? It could happen quickly, and you could see a pretty significant reversal in the performance of those investments. So it would be very tactical in nature if we were to move in that direction. But all in all, as you think about long-term sort of strategic orientation and what the objectives are of both the moderate growth and conservative growth portfolios, really no recommendations there. Blair mentioned, and we would agree with that return expectations into the future are lower than what we've experienced over the past 10 years at this point. And that's why evaluating the opportunities like private markets is something that the investment committee is currently going through.
It's a very tricky sector.
Yeah, Steve, just as a follow-up to your question, when you're asking about performance against peers, we obviously provide the performance against benchmarks, but are you asking about how the Jewish Foundation performed compared to other community foundations, other endowments? Is that your question?
Yeah, so exactly. So
Yeah,
for example,
Asher, maybe I don't know if you have that information available, but I think that is published. Asher, what do you think about that, gathering that data?
Yeah, so we do, as part of our reporting platform, have what I'll call universe data for other endowment and foundation organizations. And we can look at that data as a broad universe, all E&Fs, but also in sort of subsets, portfolios that are 50 million to 100 million or 100 million to 500 million. So we're able to splice the data a bit. And we're happy to provide that information. I would say a caveat to that, and what makes benchmarking a bit difficult here, especially for something like the conservative growth portfolio, is that traditionally endowments and foundations are going to have equity exposure, north of 60%, whereas the conservative growth portfolio has a very different asset allocation structure and set of objectives in play. So we may be able to look at some universe data of portfolios that, let's say, only have 50% in equities or 40% in equities as perhaps a better comparison for conservative growth portfolio. But we do have generally that level of information.
Yeah, if you can pass
Blair,
that, we can get it to Steve.
So Blair, as you had suggested, so if we were a university, we'd be looking at the NACUBO benchmarks. I assume that there are similar peer groups within community foundations, and even though we may have different funds that make it hard to compare, it'd be interesting to see how our funds compare to other funds or other institutions' funds, and if we're on the right course.
Yeah, we can work on that. Asher, we can try to pull together and try to gather some information.
Yeah, I'm confident we can pull something together there.
And Asher, how are we balanced to the global markets? And I assume you think we're appropriately balanced?
Yeah, that's another great question. So from a strategic perspective, as I think about equities, both portfolios and the ESG pool as well, are going to be roughly 60% in US equities, 25% in international developed markets, and 15% in emerging market equities. That is a strategic view that we have at NEPC, and that represents a slight overweight to US and emerging markets and a slight underweight to international developed equities. Taking a bit of a deeper dive there, we also have a slight bias towards small cap equities relative to the benchmark as well. So roughly 20% of the US, the international emerging exposure, is going to be in small cap equities as well. So sort of an 80-20 large cap, small cap allocation as part of that.
And last question, then I'll stop. Have we defined target returns for the year for the different funds and benchmarking against how our target is looking?
Yeah, we have. So moderate growth portfolio has a target return over a full market cycle. Not year over year, but a full market cycle of CPI plus 4.25%, conservative growth return objective of CPI plus 2.25%. The ESG portfolio benchmark is trying to achieve a return equal to the 60-40, 60% MSCI ACWI, 40% Barclays aggregate index.
Thank you.
Thank you, Stephen, for all the questions. Does anybody else have anything that is on your mind that you'd like to get answered? Okay. Well, we're willing to hang on for a minute, so if somebody has something they want to ask, we'll call this adjourned. We thank you for being fund holders with us and being interested in caring about your investment, and just know that we have robust process and system in place to make sure that we are monitoring and tracking the investments and taking good care of our fund holders. So have a wonderful afternoon. If you do have some additional questions, like I said, Blair, Asher, and myself will be willing to hang on. So thank you all.
Thank you, Jory. Thank you, Asher.